Hello everyone and welcome back to the channel. This is Fair Value Finder and today we're taking a look at Tyson Foods Incorporated, ticker TSN. This is the largest individual stock holding across my portfolios, and I'm going through and evaluating where I think each company's value is going to be at the end of this year, so I can take profits, know what I need to buy more of, and so on. I'm starting with the largest. After this, I want to go through some of the S&P and see where their valuations are. But Tyson's the biggest. I've held 100 shares for a while of this, and I actually recently started trimming it back a little bit. I'm down to 90. Currently trading for $61.66, so that is almost a $6.2 thousand position. I just don't see really the growth that I want out of it. I bought way back, mostly for the dividend. They struggled with a few things. They keep closing factories, and they had a whole scandal with their CFO and had to get a new one. We're struggling there for a bit. Seem to be on a bit of a better track, but I've gotten a decent amount of profit. My average cost, $49.96. So I am up nearly $12 a share on my 100 shares. In dividends, I've collected $258. And then through selling covered calls, trading options, it was a pretty easy one, staying steady, dropping, that I was able to make $1,487 off of trading on. I am up significantly on it and not too terribly attached to it, so I do want to trim it down. Part of the reason for that, this right here, it's just not the 8 to 10% we're looking for. You know, they're paying out a dividend of 3.26% right now, but slowing down on the dividend growth and revenues coming in lower than inflation. So we can get into all that now. Earnings yield 7%. We'd want $3.08 in EPS for what we're paying. What we're actually getting out of it this year, expected $3.89. So on an earnings front, it's reasonably valued. Price to earnings growth, we're looking at 13.4% growth, a PEG of 1.19. So it's not overvalued. We really want to see that as close to 1 as possible. 1.2 isn't too far off. Cash flows just really aren't there. They're a very low margin business, so that's a big reason for it. We look at cash flows. They had a really down year in 2023, bounced back in 2024, 2025, came back down more in line with what we'd expect from them. And if they continue growing at the rate that we had seen, assuming some evenness between 2022 and 2025, we'd be looking at getting up to about this level in 2027. That's 1.24, where last year they came in at 1.18. Dividend, currently higher than they had been. On average, 2.9, currently 3.3. Values bounced up. They've been as low as $50 in the last 52 weeks, as high as 64. Payout ratio off last year's earnings, 49%. Decent for a dividend stock. We want to see it around this year's earnings, 50%. There's definitely nothing wrong with that dividend. It looks healthy. ROE, ROI, and ROA all look low. 2.6, 2.6, 1.3. It's not like it's getting any sort of help from the debt to equity. That looks fine. We like to see it under 1. It's basically at 1. So their balance sheet is in decent shape. Margins are super low. 6.54 on average, 7.7. Net came in at 0.9, so they almost broke even, honestly. And on average, so that is something they need to fix, is those margins. Personally, I don't like low margin businesses, because if something's not working, you don't really have the levers to adjust. If you're already at the bare minimum price, there's not much else you can do. You can spend more on advertising, which would cut even further into your margins and likely take you negative. So that's a dangerous spot. Revenues have had slow growth, right around 1%. Looks like analysts are expecting a bit of a jump up to 2%, but the Fed tries to keep inflation at 2%. We'd want to see 3-4% at least. It's not there. Share count, they're barely buying back shares. Last 2 years, they hadn't. 3 years ago, they bought back a bit, keeping it very low. Cash flows, if revenues are growing at 2, cash flows growing at 2.5, that's what we had looked at. Looks like a reasonable growth rate. From what we had seen in 2022, maybe they can grow it faster, but we'll have to see. It all depends on if they can get those margins up. Assets, 0.3. They're, again, pretty flat on assets. Not making much investments, already have a lot of what they need to operate. Liabilities, though, 1.5. We see 2.7 in the last 3 years, 1.1 in the last 2. So slowing down on adding debt, but it's outpacing the assets. So right now the balance sheet is healthy, but if they continue at this pace with liabilities growing twice the rate of the asset, it's not going to be a few years down the road. Dividend growth, we'll say 2% in line with the revenue growth. I mean, they can't really grow it above the revenues and earnings unless they want to increase that payout ratio. It all comes down to these margins. They need to figure out the margin issue. And so that's why we're putting in 2.7% gets them back up to 1% margin in 5 years. I'd like to see them do way better than that. This whole thesis gets them annual returns of 3%. Once you factor in that dividend, you're talking 6.25. So you're underperforming the market, but you are undervalued to start with. Probably part of why it's undervalued. Now, what if we try to get this margin up to 1.8? Well, if we can do that, 16% growth gets them to 1.8 in 5 years. It does allow other things to grow, like the cash flows we could expect to be higher then because you're bringing more into the bottom line. So that 2.5 could at this point be maybe 4. Not all of it makes it into cash flow. Well, now we see a 0.4% jump. They could use that to pay down their debt. So liabilities, cut that down 0.5%. Or they could use that to increase their dividend. Most unlikely scenario there. But still, it's going to take a lot to get them up to the 8% that we really look for. So what you're getting here, you're getting a blue chip dividend stock. You're getting that constant 3%. You're going to underperform the market, and that's just how it is. Unless they figure out something that's going to really drive revenue. So in 3 years, we'd be looking at a fair value of $76, and in 5 years, about $80. So buying in at today's $61, once you factor in the dividend and the discount that you're getting, if it's able to reach its fair value, you'll be overperforming the market in the next 3 years and essentially in line in the next 5. Now, if you were to buy in at the fair value, so you get into it $70-ish, you're significantly underperforming the market, almost half the returns in 5 years. So the benefit here is you're undervalued already. And the reason you're undervalued is because you're not going to perform in line with the market. That's why I'm trimming my position, because the returns aren't there for me. The dividend isn't anything stellar. Like it's a dividend stock, but it's only paying 3%. I can get more out of bonds, and if there is some sort of economic issue, that's a much safer investment. As I've mentioned in previous videos, I've been putting a lot more money into bonds lately. So we can take a quick look at the balance sheet, see how things are trending. Assets, very stable. They do have tangible assets and tangible book value. Liabilities, just gradually growing. Really flat across the board on a lot of stuff. Their gross profit was really low in 2025 because of that margin, but still better than 2023 where they ran a negative net profit. Big red flag here is this downtrend in EBIT and in net profit. And that's the margin compression that you're seeing. I'm taking my $12 gains and getting out. Final thing, I mean, you can see the cluster here. Everything is here between $60, $70 in 2025 for value. And in 2026, even tighter, closer to 70 than it is 60. With the price right now being 60. So I wouldn't be surprised if we finish out this year $65, $70. But if it hits that point, I would definitely sell out completely because it just doesn't have the returns that you'd be looking for. And you can invest in other companies that can get you something better. All the while, this balance sheet up here just gradually shrinking. You know, it hit a peak in 2024 and down $1 in 25, down $1 in 26, down $1 in 27. Lots of value there. It is the lowest weighting though because they're closing factories, and that's not really what the market looks for. They care mostly about earnings. So heaviest weightings towards earnings and dividend here, and cash flows not too far behind. But that is it for this one. If you own it, I would not go out of my way to buy this one. Yes, it's undervalued. The growth just isn't at a point where I would want to deploy new capital into it. If you hold it, it could be a hold. Get up to the $70. Reevaluate and or sell out, or you could get out now if you're sitting in profit like me. I'm just gradually getting out if I see something else that I can redeploy that capital into, and in later videos I'll let you know what stocks I'm seeing. I'd like to go back to the what I'm buying this month videos at the start of every month, so that way you can see which stocks I'm buying and trading. So I want to be better about balancing and deploying capital. And I'm going to be digging in deeper and letting you guys join the ride if you find it helpful. So thank you guys for watching. Please like, enjoy the video, comment what other stocks you should take a look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.